Welcome back to Real Estate Mindset. This video is going to be absolutely bonkers, you guys. And good morning to you. Happy Monday. I got some really good stuff for you guys planned out today. We're going to go over a market update. We'll go over the mortgage update, but I really want you guys to stick around for the value calculation segment of this video because I'm really going to break down, basically, guys, I'm sick of the whole talk about value. So I'm really going to break down on a consumer level, how value works by opening up the MLS. And I'm going to tell you guys exactly why real estate is so hyper local and what you should be looking for in your own metro area. So I got that lined up for you guys today, but I wanted to talk about this comment real quick from Vegas. Vegas, you got to change your icon, brother. I can't keep it up here that long. I think it's hilarious a little bit, but basically here's the thing, you guys. So basically some of the viewers that came on early this morning, we were talking in the live chat and they wanted me to talk on basically those all cash offers. So back in 2020, predominantly 2022 and into 2021 as well, people were making all cash offers. Okay. These all cash offers had I think it was 4 or 5 times more likelihood that that offer was going to get accepted. So all of the buyers that were freaking out in the peak of the fear of missing out, they only wanted to put these fake all cash offers in. Now, here's what's important to understand about these all cash offers. And there's maybe some type of meltdown situation going on right now in mortgage-backed securities. So I'm going to explain that to you guys right now. But in order for me to explain it to you, you guys have to understand that in 2009, they passed that Dodd-Frank Wall Street Reform and Consumer Protection Act, okay? So the great financial crisis happened, they passed this law. Now, this law created something called QM. So I want you guys to remember QM. That stands for Qualified Mortgage. Very, very important, because what this is basically saying is, the government, right? It's crazy that they even made these laws. So the government is saying that, hey, lenders, if y'all lend to people that can't afford their mortgage payment, because remember all the stated loans back in the great financial crisis, you can't do that anymore. So the government's like, if you guys lend to people that can't afford their houses, we're going to allow them to sue you and you got to pay them everything, right? So the banks were like, oh, then we're not going to lend to people, right? So basically what the government's saying, unless these banks are lending in a criteria that they've created under the QM guidelines, qualified mortgage guidelines, so it can only be a 30-year mortgage, no stated income, right? Has to be a fixed rate, like the vanilla. The loan has to be vanilla. It can't be fancy, okay? So here's what has happened, okay, potentially, and I don't know this for sure, but these loans that were the all cash loans, what it appears that has happened, first of all, they got very, very popular. People were selling these loans before they even understood them. So what may have happened is a lot of these mortgage companies to continue to maintain market share and continue to do business, lent these loans out, right? The only problem is it appears that these loans did not fall under QM guidelines, okay? So what happens is mortgage lenders, they lend a whole bunch of money, but they have to stay in business, so they have to continue to lend money. And they only have so much money. So say they only have $100 million. They lend $100 million, but in order to stay in business, they have to sell that money to get more money. And a lot of lenders are selling to Fannie Mae and Freddie Mac, okay? So it appears what happened is, and again, we don't have enough information on this yet, but it appears that the loans that these mortgage lenders were selling back to Fannie Mae and Freddie Mac under the QM guidelines were BS. It looks, and again, I don't have enough information on this, but it looks like it is possible that that's about to blow up in these people's faces, those all cash loans. So the all cash loans, it appears, again, I don't know this for sure, but it appears that they were selling these loans back to Fannie and Freddie when they did not fall under QM guidelines. Again, it appears that way. I don't know 100% for sure, but I'm going to tell you guys right now, the impact of doing that is going to be severe. I can't explain to you guys how bad something called a buyback is. So if Fannie Mae finds that all these lenders were, they're buying loans that were not qualified mortgage, they're going to require the lenders to do something called buyback. Okay. Now a buyback requires the lender to forfeit all of the profit that they made from that loan and to refund the loan amount. Okay. Huge deal. A buyback impacts almost every single person involved in the transaction, including a loan officer. So for example, you guys, like as a loan officer, okay, the company that I work for, if I gave a loan to someone and within a year, okay, so there's usually a year clause in commission agreements. If in 1 year, the loan that I just gave to a borrower is like refinanced or it was done improperly or something like that, a buyback is generated. Basically, it's saying that, hey, they didn't hold on to the loan for a year. You have to refund us all your money. And as a loan officer, I would have to refund my commission. So if you guys want to see me upset, you should see me when my employer tries to take back my commission, right, for work I've already done. So my point in telling you guys this is buybacks will absolutely cripple mortgage companies and cripple the industry if that happens, and that will also hit the loan officer. So it is a massive deal. Buybacks will absolutely destroy the industry, and I'm not joking about that. So hopefully that answers your question. Now, what I'm going to do, guys, is we're going to jump right into our market update right now. I just wanted to answer that question for you guys that came here early. So we're going to do a timestamp right now. And let me make sure that I'm teed up real quick. I think I am. All right, there we go. All right, guys. So let's start with our economic calendar. I want to tell you guys what's going on this week. We got some really important. There's Johnny. Johnny, you're up late. You need to wake up sooner. Okay, you're getting lazy, Johnny. All right. So, anyways, you guys, we're going to start with the market update right now. Here's the calendar of economic things that are happening. Got some good inflation stuff coming in this week. Starting on Tuesday, we're going to get the CPI report out on Tuesday. So that's a pretty big day if you follow CPI. We're also going to get the PPI out on Wednesday. So again, Tuesday, Wednesday, very important. Look for changes in the CME Fed Watch. I'm not going to pull that up today, but look for changes in the CME Fed Watch immediately after CPI comes out and PPI comes out. Is there anything else? Okay, so Thursday we get initial jobless claims. And then Friday, we get some housing market stats with the starts and with the permits. Now, I suspect this is going to go down. I suspect this is going to go down because the builders are starting to figure out that we're probably in the second round of recession in the housing market. Right? Changed my mind on that. Now, a couple other things, you guys, take a look at this. This is big. I mean, I can't tell you how there's so many things going on right now. I don't think any one thing alone would crash the housing market. But the fact that we have so many simultaneous headwinds and cross currents, I mean, come on, you guys. I mean, around each corner, there's something new. Around each corner, like the forbearance plans being extended to November 30th this year. I didn't know that. I did not know that 70% of serious delinquencies were protected by COVID forbearance plans. I didn't know that 70%. So anyways, sorry it took me so long. But anyways, guys, this is huge. Moody turns negative on U.S. credit ratings. So this is really, really big. This is probably going to downgrade all. This is going to be interesting to see how this unfolds. But let me read a little bit of this for you guys. Moody on Friday lowered its outlook on U.S. credit rating to negative from stable. That's crazy, citing large fiscal deficits and a decline in debt affordability. Duh. A move that drew immediate criticism from President Joe Biden's administration. And I'm not going to get political because I respect you guys way more than that. The move follows a rating downgrade of the sovereign by another ratings agency, Fitch, this year, which came after months of political brinkmanship around the U.S. debt ceiling. So the world is just getting fed up. Now, right now, no one can replace the dollar. But that doesn't mean, 2-3 decades from now. I mean, eventually, if the U.S. continues to be a bully and prints so much money, the world is just going to get tired of it eventually. They can't do anything right now unless the entire world stopped using the dollar. So this is a very interesting thing. It's kind of like the world is stuck. But anyways, let me keep reading. Federal spending and political polarization has been a rising concern for investors, contributing to a sell-off that took U.S. government bond prices to their lowest level in 16 years. A lot of craziness in the market, a lot of uncertainty in the market. It is hard to disagree with that rationale with no reasonable expectation for fiscal consolidation anytime soon. So deficits will remain large, and as interest costs tack up a larger share of the budget, the debt burden will continue to grow. So tell me what you guys think about that. I just don't know how to feel. I mean, I just am depressed, But I'm going to be 40 next month. So, I've been around the block a little bit, and I don't believe in just getting things for free from the government. I'm not going to go there. Anyways, guys, let's move on to the 10-year right now. Here's what the 10-year is doing. This is the economy crusher. All right, look at this. Huge run up right at market open. Look at that. Huge run up. So we're up about 5 basis points. Very, very intriguing to see this. I'm not 100% sure why, because I exited out of Market Watch, but it's up 4.5 basis points at 4.69, about 4.7. And look at this. Look at that spike upward, you guys. Now, again, remember, this is going to be the economy crusher, the 10-year, 20-year, 30-year. Okay, so that's killing the economy. Let's look at the other other star of the show, if you will, which is the 1 month. Not sure why this is remaining unchanged. Is it still unchanged? Okay, so that's remaining unchanged as well. Okay, so that's 5.4. So that's up slightly as well. That's above the reverse repo market. This is the liquidity zapper. Take a look at this, guys. This is epic. Okay, here's the reverse repo market. Let me move my picture. Here's the reverse repo market. We've been watching this because this is like a lifeline to the economy. This is, life support, if you will. This is liquidity, money printing from COVID, excess money, if you will, in my opinion, and that's how I'm describing it. But it looks like we are headed down again. So it looks like we're off this plateau. You guys see that plateau right there? And we're headed down once again. We are under 1 trillion. Again, we're sitting at 993 billion. But I want to let you guys know that's still a lot of money. But if you guys go in and you look at May, the end of May, we were sitting at 2.2 trillion. Okay. So the end of May, start of June, we were at 2.2 trillion, and we're already down to under $1 trillion right now. So even though it's still a lot, understand that the money in the reverse repo market is dwindling rapidly. Let me show you guys what the market is expecting as far as inflation. Now, here's the 5-year break-even inflation rate. This is something that the Federal Reserve watches regularly. They do not want inflation expectations to become unhinged. So this is, again, something they've been watching. Now, it is still elevated. This is, again, needs to be at 2% or under. So again, this is saying a very clear indication inflation is not transitory. Inflation is here to stay. And this to me shows we're going to be higher for longer. Because again, you guys, look at this run up right here. See that run up? So it was basically sideways, sideways, sideways. And then the cat kind of, came out of the bag here and like, oh yeah, the summer stats are coming out, whatever. And it shot up. And now it's gone up day over day. So keep your eye on this. It has been going down, but keep your eye on that. You guys, it's 2.3. The Fed does not like this. They hate this, by the way. Let's move on to the inversion. Really, really interesting movement in the inversion. This is something we watch regularly. This is the 10 and the 2 inversion. This is the warning sign for the recession. This is, again, our forefathers saying, hey, don't listen to realtors and investors. They're foolishly optimistic. Listen to your forefathers because your grandpa and your dad knows what's best. Or something like that, right? Or really, it's just the bank's not making money. So one of the two. But anyways, guys, it's still going. I mean, it was, the inversion is crazy. It's gone, day over day, it's made a change towards reversion, but we're still 41 basis point apart. Last time we were there, I think, when was that? October 13th. So we're at October 13th levels. The reason why we've been watching this is because it had a massive bear steepening, so it's reinverting, right? I'm sorry, uninverting. Okay, that's from the longer end of the yield, the 10-year. That's known as the bear steepening. And we almost reverted. Look at this. This is why we've been watching. We almost reverted. We're coming so close, you guys. We came 13 basis points away October 25th. So we went from 13 basis points to 41 basis points. But I, again, want to let you guys know, look at how fast that can change. I mean, in a matter of a week, we can be back and reverted in 1 week. I mean, look at the run up right here. This was the bank bailouts right here. And then this was like reality right here, and that 10-year blowing up. And then right here, you guys, was when, the first, I believe this is when Israel got attacked. So like, this is right when Israel got attacked right here. Very, very interesting to see how that works. So that's our market update. We're going to go into our first video right now, you guys. And then after this video, we're going to go into the value segment. Okay. And the value segment, again, I'm going to show you how during the value segment, I'm going to show you again, why, being local when it comes to real estate is important. And I'm also going to show you through showing you how value works, what the new builders are doing. The new builders right now, I can't tell you how manipulated the prices are in new construction. And even with the prices of new construction being manipulated, it's still down 15.7%. So you take away the manipulation, the prices of new homes right now, you guys, they're down more like 20% right now. I'm going to show you guys that in a minute, but we're going to go into our first video. Now, this video, I want you guys to hang in there. It's a long video, okay, from some really smart people at CoStar. Okay, it's about 7.5 minutes. I want you to bear with me on this. The reason I'm playing such a long video, you guys, is it's covering a lot of good stuff. I like how they're going into the commission lawsuit with realtors. But again, this is from CoStar being interviewed. So I hope you guys enjoy. And if you can, let me know that the audio is okay.
At the Barron Conference, Ron Barron, what did you say it was, 47 times?
47.3 times.
You've made 47.3 times your money.
Right, so far.
So far.
Right.
And you think you're going to make what when it's when?
A lot more.
Where can it go from here?
Well, I remember meeting with Ron first time, and we had trailing year revenues of $7 million. And I spent the meeting trying to convince him we get to $100 million. We're now approaching $3 billion. And I believe the next stop is $100 billion in revenue.
Did you get that?
I got that. I clocked that. Let's talk about the real estate market right now. There's a lot of questions about what's happening. I mean, we were talking about interest rates and what that's doing effectively to the real estate market. There's this lawsuit and the results of that may have a very interesting impact on your business. What do you think?
Yeah, so we're in I think there are two separate components there. We are with raising interest rates and depreciation we've seen in the house values over the last, since the 09 recovery on up to basically the same climb we had before the 08 bubble. You bring in then these interest rates moving from 3 to 8.3, and affordability has dropped down to the worst it's been. The fewest number of Americans can afford the average house. We haven't seen anything. We haven't seen the market, buyers priced out like this since 1985. So it's a tough market. Volumes are way down.
And what does that mean, by the way, to your business? When volumes are down, how does that impact you?
We have about 15 different companies, and they serve different sectors, and they're all very counter-cyclical. So when one component of the market is going down, another one goes up. So for instance, we may be providing services to lenders evaluating their loan portfolios. In a down market, that goes up.
Like apartments go up when houses go down.
Right. And so apartments go up, and then you might be moving in next year into a recovery in the office market a bit, and that market goes back up. But a big part of what we do is we have about 1 billion people a year search our websites for all kinds of real estate. And when things get tough, people tend to invest a little bit more in marketing their real estate, and we're a beneficiary of that.
So, I assume two things happen. They invest more in marketing their real estate, but there's less volume of stuff.
Correct.
And I assume right now there's really less volume of stuff because people are less mobile right now.
It's down dramatically. It's 30-40%. It's down probably 45% on the commercial side. It's down probably 30-some% on the residential side.
And that's in the U.S. What does Europe look like? Because I know you have a big business there too.
Yeah, I think this is my 5th country this week, so similar there.
Similar there.
Welcome to the United States.
Yeah.
What do you make of the lawsuit that we talked about at the top of the segment, and what it means to the real estate industry, the brokerage business writ large, and what may come as a result? Meaning, there's a lot of folks who think that the commission system, the model that we know, is effectively going to be upended by the results of this case, and then maybe antitrust regulators and others doing this more broadly around the country.
And how it impacts the other companies who are competing against us.
For sure. So we are. I think people are a little slow to grasp what's happening. We've been watching this come for about 1.5 years. People didn't believe a jury would actually return a verdict that was this significant, but it's a $1.8 billion verdict, which will be trebled to about $5.4 billion, and this was just for Kansas.
Right.
So that means the rest of the United States is to come, and that could take the damages up to about $400 billion.
Real quick, guys. So $400 billion. Okay, NAR has $1.25 billion. So again, this is the end of the operation as we know it, to be honest with you. Okay, let's keep going.
And I have begun to hear about another theory of damages around a commingling rule in the MLSs, which could escalate it even more. So I think it's highly likely.
If you had a $400 billion penalty, I mean, you would wipe out the profits of the business for how? I mean, for a decade or two.
The plaintiff attorneys will negotiate basically all the cash and all the borrowing power out of these major brokerage firms, MLS, take away everything. They'll try to appeal, but you have to post a bond of 10% of the damages to appeal. That'll be very difficult for a number of these companies. So there'll be a bunch of copycat cases, but at the end of the day, I believe the broker participation rule, it says that the seller must pay the buyer's broker's commission, is done. And the DOJ and FTC will probably follow this lawsuit and weigh in and say that's done. And when that's done, it's interesting. It will definitely upend and turn the market over, and there'll be some big winners and losers. Some of the brokerage firms who have judgments
All right, guys, a couple things real quick. There's about 3 minutes left, but another person talking about the DOJ, the Department of Justice, getting involved. So the Department of Justice, just to let you guys know, and if you're a realtor, just so you know that this is serious, because I'm still getting comments like, oh, don't worry, they're just going to appeal. Of course they're just going to appeal. They always do, but it's a 10% bond to do that. And the Department of Justice is watching everything right now. And they only lost in Missouri. The flood of lawsuits right now to the National Association of Realtors and the top brokers is out of control. Now, I want you guys to pay attention to how, is my camera okay? To how unrealistic he's about to get. One of the reasons why I paused it, because I liked everything he was saying, but listen to what he's saying now, okay? This is crazy.
Some will have a tough time. The agents themselves, I don't think they've figured it out yet, but I did an analysis yesterday where it's clear that about 85% of real estate agents in the United States do both seller representation and buyer representation. As the buyer representation component goes away, they no longer have to split their fee with a buyer broker. Their commissions would in theory double, so they get twice the money for less work. So the agents are winners.
But unless you think the rates are going to go down, because they're going to say, I'm not paying 6% for this.
Rates will drop 150 basis points.
But you don't think that you don't think it goes from 6 to 3?
No, I think there's KB did a good analysis that I think is solid, which it will come down to about 3.5.
Okay, so if you're a real estate agent watching this morning, we're thinking about the rest of your profession.
It's good.
Professional life. You think it's actually good?
If you're a seller agent, there are about 10-15% generally less experienced agents who work with a Zillow or Realtor getting these sort of leads where you split your commission with Zillow Realtor. Those guys are going to have a really tough time because the business models that rely on selling buyer leads on Zillow and Realtor, I believe those will completely disappear and have to be, reconstituted as some completely new revenue model.
That's big news, you guys. I've been into real estate for over 20 years. It's going to change, and it's going to change like crazy. So I felt like it was really interesting. So what he thinks is going to happen is commission overall is going to go from 6% to 3.5%. But then you have to ask yourself this question. I thought it was negotiable. Why does everyone talk about 6%? Why do I talk about 6%? The reason I keep talking about 6%, you guys, is because it's almost always 6%. If commission is negotiable, where's all the $1,000 commissions? Where's the 1%, right? It's almost, not always, but almost always 6%. And that's, again, huge problem. To 6% to sell a house is brutal, man. I get roasted from my peers for saying that, but I mean, it's really what I believe. What am I supposed to say? So we're going to go to the value part of this video. And this is going to be something very eye-opening for a lot of you. Now, basically, if you guys saw this video right here, if you didn't see this video, go watch it. This is from George Gammon. Okay, now I watched this video. I'm not going to play it for you, but when I watched this video, when he was talking about the value of the housing market being set on margin, I was like, okay, this is going to be something that I can talk about today and access MLS and show you how it works. So we're going to talk today. We're going to talk now, guys, about value. And in order to do that, I have to basically explain a few things, and then as I'm explaining this to you, it's going to make a lot more sense on how bad a situation the builders are putting us in. Because remember, the builders aren't making deductions on value for buying incentives like a fixed rate mortgage, okay? So where I'm going to start is I first need to show you and explain to you how an appraisal is calculated. Generally, in order to come up with value for a piece of property, an appraisal has to be done. Generally, that's ordered by the lender. Now, generally, when an appraisal is done, the appraiser takes 3 homes that have sold within 12 months in the property's subdivision, unless it's rural. Okay, we're just going to talk about most stuff. And I always get, oh, well, what about rural? Okay. There's a 0.1% over there too, but subdivision. Okay, so you have to find sold houses in a subdivision. And generally, just again, I'm going to oversimplify. So I'm oversimplifying. So generally, you take 3 comps, you add them together, and you divide by 3. Okay, for the sake of argument. So let me explain this real quick to you guys by showing you this right here. That is not working. Of course, it's not working. Okay. Darn it. Okay, so I'm going to show you something else instead. All right. I'm going to show you this over here. Okay, I can't show you that part. I'm really embarrassed about that. My iPad's not working. It broke this weekend, probably because of that Friday episode that I did that I got roasted because of my breathing. But I have to tell you guys, I was 5 minutes late. My power completely went down, and I was never able to rebound from my stress levels. Sorry about that. But look at this, guys. Okay, so let me show you guys this instead. Okay, so talking about value, we're going to talk about being hyper local. Okay, so I'm going to show you guys, and then I'm going to go back to the building here in a minute. Okay, so I'm going to explain to you guys now why real estate is so hyper local. Now, we've been doing something called market analysis. You can literally go to my channel, go to the value playlist, and you can play the how appraisal value video works or the market analysis video. But again, I only want to show you guys Kingwood. Okay, so let's just pull this up real quick. Okay, and again, this is going to look familiar to some of you guys. So, and this is, let me pull this up and I'll show you. Bear with me. Okay, here we go. Okay, now let's pull this up and I'm going to start talking about this. Okay, now what we're looking at here, you guys, is Kingwood. Okay, so what I'm talking to you guys about right now is value and how important it is for real estate to be localized. We can't look at national stats. The reason I talk about national stats all the time is because I have viewers from all over the nation, and it's an indicator of what could be happening in our local markets. But you guys, look at this. When I really scroll out here, you can see, look at, there's Houston. So Houston is huge, right? We have cities all over the place, but again, real estate's about hyper local data. So if I want to know what's going on in Kingwood, I'm only reviewing Kingwood data. Do you see that? So there's Kingwood right there. So I don't care about Huffman. I don't care about Atascocita. I don't care about Humble. I only care about Kingwood. However, what's very important is yeah, you could do a market analysis on a city, but you guys got to go even more local. You can't just do an analysis based on city. Let me show you guys. So when I zoom in here, again, this is just to Kingwood. Okay, this is just Kingwood. Remember what I've been telling you guys, it's about subdivision. So within each city is another localized set of data, and that is found within the subdivision. You can see here, there's a subdivision in Greenwood Lake. Here's a Kings Manor. Here's, what is this, Woodland Mills Village. Here's North Park Place. Here's some other subdivision right here. Here's a subdivision right here. Here's a subdivision right here. You have to go directly to the subdivision or you will never know whether or not a price cut is true, and you will never know whether or not you're getting a good deal. You must look at sold data in the subject properties subdivision. Okay, I hope that made sense. Let me know, you guys, if that makes sense. Does it not make sense? Hopefully it did. So that's what I wanted to show you guys there. I'm going to show you guys now one more video, and as I'm playing this video, I'm going to try to fix my little toy here that does not appear to be working. See, look at this, guys. I don't think it's working. See how much does that suck? I had something so great for you guys. So I'm going to come back to that. Let me play the second video. The second video is really good as well. So let's go into this one now. This is going to be a lot more. Basically, they think this is going to be on someone thinking that the Federal Reserve is going to cut interest rates next year by 150 basis points. So if they cut interest rates 150 basis points, y'all, something really bad is going to happen. So take a look at what he says. This is about a 6-minute video, and I'm going to go try to fix my iPad right now. So enjoy the video, and I appreciate you guys.
Is here. Steve, don't go anywhere. Founder, of course, chief U.S. economist at Pantheon Macroeconomics. Your expectation for what we're going to hear at 8:30, but more importantly, translate that for maybe what you think it does to the Jay Powell School of Thinking and the rest of the market.
Yeah. So every time we've had a big upside surprise in the last couple of years, the next month has been a downside. So I'm assuming the pattern continues and I've got a downside. So I'm looking for 125, 150, something like that, a bit below the consensus. The range of
and then does the market love that?
I think it does, provided the unemployment rate doesn't somehow drop back down again. The market wouldn't like that. But if unemployment hangs around that 3.8 mark, where we've been for the last couple of months, and the payroll number is 125, 150, that would play well. I think that would allow the market to hold the gains from the last few days.
Okay, that's the equity side of the universe.
Yeah, bonds would probably like it as well, up to a point. We had a nice rally. Bond market really wants to see some sustained evidence that pressure Steve was talking about is diminishing. And I kind of think that is where we are now in reality, whatever the numbers say any given month. I do think that pressure is beginning to fade. You can see it in the wages data, you can see it in the business surveys, and it's starting to come through.
Okay, so with all this fading, you play this out into 24, are you then in a recessionary camp?
Close. This is a very weird economy. You've got the Fed raising rates against a private sector whose finances generally look in pretty great shape. So you've got the Fed pushing, and you've got the private sector kind of pushing back, which you've never had before. So it's very uncertain as to how the dice are actually going to fall. I mean, I do think growth is going to slow a lot. Whether that tips into an outright recession, I think is kind of a 50-50 call. But I'm pretty convinced it's not going to be a bad one. If it happens, it's not going to be a bad one because the private sector is not in the sort of condition where you need a big correction, you need a big change in behavior. So it's light years away from where we were in like '08, but even better shape than we were in 1990 or the recession of '01, and they were very mild.
But do you think that the market's already baked in a recession and therefore we're like almost, I don't want to say almost past it, we're like almost past it because it already, it hasn't happened, but it's like happened in the head of.
Look, if they had baked in a recession, we would be in a recession, right? Is that, I kind of think that businesses, they were on their guard. And this is, again, a cultural, psychological question. Because if you are sure a recession is coming, you pull back your production, you pull back your hiring. They didn't do it. I think they maybe did less than they otherwise would have. But if you look at not just the predictions of the recession, but the hubris and the certainty of the recession that was about to come but did not arrive. I was interested in your interview with Mr. Harvey there the other day, Professor Harvey, just in the last hour, who is so certain that the savings that went out for consumers. Okay, give me $1 for every time that they've told me the savings that went out for consumers. They haven't. They're also, I think, underestimating the importance and the power of wages and employment on consumption. So I'll leave it there. It may happen. It may happen next month, but it's not happened.
Yeah.
Is it coming in for sure?
Nothing's coming for sure.
Okay, thank you.
One thing I've learned over the last 3 years is that nothing is certain. Things that you thought were impossible will happen over and over again, and things that you thought would be certain don't happen. So that's the lesson of the last 3 years. This is why Jay Powell keeps talking about how forecasters have to be humble. I mean, it's not a coincidence that he's talking about this.
But here's a related
Didn't Jim
question.
Morrison say the future's uncertain, the end is always
So
near?
at the very tippy top of the show, Joe made a very important point. We were just talking about we're in November. A year from now will be a presidential election, right? Like we'll actually. So where
everyone's just really thrilled about it.
But where do you think the economy is come September or October?
Yeah.
Then of next year.
Okay, so I think that whatever happens in the next 6 months or so, it's probably on the way out of that by the time the election comes around. But I don't think we're going to be seeing an economy at election time that's either in meltdown or in some sort of boom. It's going to be kind of meh, So, and I can't. That's my story for the whole of 2024. It starts off really meh, and it's a little bit less meh by the end of the year. It's not going to be a great year, and we'll probably have a higher unemployment rate, but we will have much lower inflation. Much lower inflation.
But okay, so if that's the case, Ian, I'm going to paint a different picture, and this is the clip they're going to roll back a year from now when it's terribly wrong. But anyway, you just said inflation's coming down. If inflation's coming down, it's likely the Fed is cutting rates.
Yeah, oh, absolutely.
The Fed is cutting rates. All of a sudden, the fear from Professor Harvey of the meltdown in the banking system from the banks and what's on their books kind of goes away and eases back. Banks might begin to lend. We could be that scenario starting from the foundation of lower inflation could spin a much more optimistic story. No?
Probably for 25 rather than 24.
Okay.
I think these things take a long time to work through. That's the other thing we've all forgotten. We're all very impatient. We want things to happen quick. But monetary policy works.
But you're in the camp. Hold on. You're in the Steve. So are you now like the gun luck camp of thinking that we're going to really cut rates like 200 basis points? I mean, that's it.
I'm not 200 basis points. I'm more in the, you know what? I don't think the Fed is going to remain on a real basis tougher than it needs to be. It will have to automatically or axiomatically reduce rates because if Ian is right, inflation comes down, the Fed doesn't want to put that much pressure on the economy. It will ease back gently to provide either a stable or a slightly lower real rate.
Yeah, no, I agree. I think they're going to.
Okay, gently, right? So, I don't know. Let me know what you guys think. Under what situation could the Fed cut interest rates 150 basis points, and buying demand not come back, right? It's a balance that they're working on. Big shout out to Charles. I want to read your comment real quick, Charles. Charles, I appreciate you, brother. Hey, man, I'm out here in Tennessee, really thinking about moving out here from California. Gas is so dang cheap. Appreciate the support, man. I love Tennessee. I love the hills there. And if you're in California, brother, it's rough out in Cali. How much is gas again in California? I think it's in the $5. Is that right? Is gas $5 in California right now? It's really overwhelming. But good news, guys. I got my iPad to work. Let me set this up right now for you. And I'm going to show you guys now. Let me just make sure this is okay. Oh, cool. Oh, wow, look at that. Well, I guess I forgot to do it the right way. Okay, so what we're going to talk about, guys, unfortunately, I had this written over here, but I had it written the wrong way. So I'm going to talk to you guys about appraisal value, okay? And we're going to talk about basically why there's such a huge issue right now with builders as long as this pen works, which I'm not sure that it's going to work. Unbelievable. So this pen now, what the heck, dude? My pen's not working now? You guys, I'm an absolute mess. I have some really good stuff. If I can't get it done today, unfortunately, because of my technical issues, like look, my pen is, I don't know, something's wrong with this. I can't do, just stop blinking, pen. Anyways, guys, we'll move on to the next thing. I'll come back here and try to get my pen working. And super embarrassing. Do y'all ever have like that tunnel vision when you're standing in front of people and you do something embarrassing and there's like that tunnel vision on you because you don't know what to say next because you didn't expect to have an issue with your pen writing? Because if you don't know what that's like, it's not a fun thing. So I'm going to move on, guys. Let's go into this other report right now. Let me pull up my screen. So we're going to do this right here. So this right here, I just want to let you guys know, this is George Rush Intercontinental Airport right here. This is a B airport or B airspace. You guys can see right here, surface to 10,000 feet. You guys also see some milestones here. This is going to give you, ground rating and from surface rating as well. Here's another airport right here. This is operating, I believe, in Class E airspace. Anyways, guys, the reason I'm pulling this up is I have to talk to someone about this. I mean, this is in my head. I'm taking my test on Tuesday, and it's freaking crazy, the stuff that I have to learn. So anyways, that was a little bit of a joke. It wasn't funny. We're going to go into our mortgage update right now. Okay, pray for me on that test. You guys, it is freaking overwhelming, that test is. Here's where mortgage rates are sitting. We're sitting at 7.56% right now. We've had a break over the last 2 weeks. We briefly hit 8%, fell back down, but we are staying elevated right now. Charles, I appreciate you, brother. I'm going to get to that. Appreciate you, Charles. We're staying elevated right now, 7.56. Raise your hand if you think that if we would have had 7.56 the beginning of this year, we would not have had this massive dead cat bounce. Well, I believe it's a dead cat bounce. We still need more info, but I mean, raise your hand seriously. And by the way, you guys, there's a house price crash going on right now in new homes on a national average. So we were not wrong about that. And remember, I define 15% from peak. They're down 15.7%. Prices are crashing right now for new homes. That's a fact. Again, by my own definition, I've had that definition for what, a year and a half? But we're sitting at 7.56%. Take a look at this, guys. I've done this a little bit differently because I've been getting a lot of people basically that don't understand this. I'm going to switch the view to this view. All right. So here's an amortization schedule, and check this out, guys. Okay, so first of all, if you guys buy a house right now, I'm not talking about 2021, 22, I'm talking about right now. If you guys buy a house right now at the average interest rate of 7.56%, your rate is really 150%. So be careful who you're listening to about mortgage rates, because again, 150%, you can see that here. You pay back a total amount of $830,000 if you borrow $328,000. Again, if you borrow $328,000, you're paying back $830,000. Now, here's what I want to start talking about after you've moved into your house. Okay, I was talking about day one. I'm no longer going to be talking about day one. It was too confusing for so many people. I'm going to be talking about year number 2. Okay, so our new breakdown in the amortization schedule, year number 2. So after you've lived into your house 1 year, you could do this anytime, by the way. You could do this anytime. But after you've lived in your house for 1 year, you've rebounded, you've bought your furniture, you've paid your moving expenses, you paid your deposits for your utilities, right? Because that's what happens when you move. After you've rebounded, now you're in year 2 on your mortgage. I want you guys to pay down your principal year 2. Okay, so year 1, rebound. Year 2, pay down the principal. Okay, that's their new theme here. Okay, and if you do that, okay, look at this. If you guys want to save these 4 tiers of interest on year number 2, if you were to pay it down to the 5-year mark, that would only take $11,261. If you guys pay $11,261 towards your principal on year number 2, you guys save 4 years and $96K. Okay? I hope that makes a lot more sense. And the point I'm trying to make here with the amortization schedule is they are front loaded with interest. And if you want to save a whole bunch of money, you pay down the principal in advance. So hopefully that made sense. Okay, so anyways, year 2, pay $11,000, save $96K over the life of the loan. Hopefully that made a lot more sense. Let's go into the affordability calculator right now. So here's our affordability calculator. Here's what I want to show you guys, okay? I'm going to show you how much someone qualifies for on making $100,000, okay? So here's my setup, $100,000. Today's interest rates, $1,000 in monthly payments. I think that's less than average, but I'm only going to use $1,000, whether it's credit cards, car loans, personal loans, school loans, whatever it is, $1,000. And honestly, that's realistic. I'm going to do a 20% down payment, and I'm only doing a 30% DTI because that's considered affordable to Redfin. Now, let me show you guys. If you make $100,000, this is how much you qualify for. Okay, look at that, 205. Raise your hand if you know where a $205,000 house is. That's a nice house. So if you make $100,000, you got to rent. If you make $100,000, you're priced out of the housing market. Overall, we're looking at average information. Obviously, there's houses that are on the bottom end of things like $100,000. I get it. Mobile homes, I get it. I get all that. But overall, you make $100,000, you're poor. We're poor now at $100,000. Is that crazy? And look at this, you guys. We're poor also because of the way the society works. We are a debt-driven society. And by doing that, by playing the rat race game and getting ourselves into debt, we keep ourselves locked in the rat race. Okay? You want to know why Dave Ramsey made so much money? He taught people how bad consumer debt is. I don't agree with all the principles. In fact, I don't agree with most principles, but one thing Dave Ramsey gets so right is how horrible consumer debt is. So when I remove the consumer debt, say this family doesn't have car loans and credit cards, they have no consumer debt. If I remove all of the consumer debt, okay, their qualification goes from 205 to $342,000. Okay. So what this means is the average person, actually above average. This is the above average person. The above average person is missing $137,000 in purchasing power because of the way society is ran, because of the way we use our debt and charge things that are not even ours. We're using money that's not even ours. You guys, people are missing out on $137,000 in purchasing power. So I hope you understand why I'm always like, you guys, get out of consumer debt, get out of consumer debt, get out of consumer debt. Let's move on to the last thing as far as our mortgage report. Just wanted to let you guys know mortgage purchase applications are down 20% year over year. The mortgage purchase applications right now have not been this low since 1995, which means, you guys, think about what I'm about to tell you. There's less business now as far as mortgage purchase applications than there was during the great financial crisis. Think about that. Think about what I'm saying. We have a housing market right now that is unaffordable as the 1980s, with an asset bubble bigger than the great financial crisis. Something's going to happen. Now, the timing, everyone's been pretty off on the timing, but something's going to break. Raise your hand if you don't agree. Tell us why you don't agree. If you don't agree, give us some reasons. Don't be just like, use your emotions. I really am interested, like, why, tell me why you don't think it's going to crash in prices. And understand this is, what I'm saying is we don't have to have a crash. Basically, we don't have to have a crash, you guys, for like foreclosures and things of that nature to have prices go down. We already see it in new home construction. We already see that, right? So let's move on to our last thing here, guys, which is our last video, and then I'm going to wrap this sucker up. This is going to go into how the 10-year Treasury is more important than the federal funds rate, because remember the 10-year Treasury is tracking the residential mortgage rates, not the federal funds rate, although it manipulates it. Obviously, the federal funds rate manipulates the market, right? But again, you watch the 10-year, that's going to show you what's going on, and let's get started now.
Still expects the 10-year yield to end the year at 4.3%, which boosts his case for 4,600 on the S&P. Joining us now, Citi U.S. equity strategist Scott Kroner. Scott, give us a sense of how we get to those levels.
Well, I think it's important to recognize that we are still in the cusp of the 10-year yield as being the dominant influence right now, and you know, we're using a 430 end of the year level, which is our rate strategist view. I'd remind that when we were near the equity highs back in July, we were at that point arguing that 10-year was bound closer to 4%. So we're still in this world where I think the 10-year becomes more important as an indicator from here than does the Fed funds rate.
Oh, interesting. You note in your latest note that there's a clear division between leaders and laggards in 2023's year-to-date market action. Does that make this environment better for stock pickers or better for ETF purchasers and those looking to track the index fund?
Well, I mean, we think as we go into 24, the circumstances are going to change. It's pretty clear right now. You still have this momentum leadership around this mega cap growth or tech cohort. Going into next year, we think we're going to see a much more balanced sector earnings growth profile, and that should lead to a broadening out effect. And when we talk about our mid-24 target, which seems crazy, but we're at 5,000, that's going to entail ongoing leadership from bigger cap growth, but a broadening into other areas of the market that have been mostly left behind this year. So to Mike's point, I think we're looking at next week as an important signal because we're going to get a bevy of economic data that's going to support or not this ongoing inflation deceleration argument.
And by most accounts, you know, where we're at now with Q3, it's been a pretty solid quarter for earnings. It's just guidance that has really spooked investors. What do you think that portends for Q4, our current quarter, and going into next year?
Yeah, so, you know, we've been pretty constructive on the earnings picture for the S&P, and going into Q3, let's just set this up. We were looking for a flattish year over year. We ended up getting roughly plus 4% growth with Q3, but that came at the expense of Q4, where, you know, previously expectations were for plus 8, now they're at plus 4. What we think has happened with the Q3 reporting period is that you've got very expected cautionary commentary. But in general, the macro backdrop is such that we think going into the Q4 reporting period, we'll get another decent positive surprise situation similar to what we got with Q3 results.
Scott, you guys did a great note a few days ago just looking at fiscal sustainability and that whole conversation. One thesis you guys put forward was that the most palatable political solution might be to raise corporate tax. And I wonder if you guys are doing odds on that and whether or not it's putting a ceiling on the market.
Yeah, this is real, you know, thought stuff, Carl. But, you know, when we look at the deficit as it's set up right now in the CBOE projections, it certainly gets scary when you begin to factor in current interest rate levels. And we pointed out in our note that the CBOE's projections are based on 3% rates, which doesn't seem like it's the right place to be right now. So what we're suggesting is we get through the 24 election cycle and get into 25. We're going to have debt ceiling issues again, but we think importantly, the discussion around some combination of higher taxes, probably ways to fine tune or lower the government spending levels will have to come into play. And essentially what that does is introduce a potential era of fiscal restraint ahead. Which again, it's out there. It's not something that we're basing our primary view towards the U.S. equity markets on right now, but it's certainly a consideration for us as 24 unfolds.
Oh, as 2024 unfolds? Okay.
When we challenged ourselves to create the world.
All right, guys, I got this pen to work. I'm not sure for how long. I want to show you this real quick. Let me just do it like this, okay? So I'm going to show you guys how appraisal value works, okay? And remember, we need 3 comps. Generally, it's averaged. Oh, my gosh. Oh my gosh. Okay, so this is going to be, hold on one second, guys. Let me make sure I have my data up here. Hold on 1 minute. Really sorry. Just want to make sure I have my data up here. Yes, okay. All right, here we go. And I had to log in real quick. Okay, so I'm going to be accessing, actually, I already did that for you guys. Okay, appraisal. Now, I want you guys to understand, remember, the appraisal is basically the property's subdivision. So it's done in the subdivision, okay? Sorry for the horrible handwriting. And my picture in the way. Dang it. All right. So again, 3 comps or sold properties are generally used, and an average is created, okay? So let's say there's 3 sold properties. You guys can see that, okay? One property sold, we'll say for 100,000. Okay, that's one comp. Another property sold for 125,000. Okay, that's 2 comps. Our third comp sold for 100 and thought my pen just ran out 150,000. Okay, and again, this is oversimplifying the appraisal process. So each of these houses sold in the subject property subdivision. So generally, again, what the appraisal will do is add all 3 of those together and divide by 3. Generally, okay, that's the simplified version. So in this scenario, simplifying this, the appraisal value would be 125K. Okay, that should make sense so far. Okay, so again, just hold on to this basic principle with me. And then I'm going to show you what the issue is with the new home builders, okay? So again, you guys should understand we need 3 comps. And where do we need those 3 comps? The subject properties subdivision. If it's rural property and there's no subdivisions, it becomes a little bit harder, but most places are in subdivisions. Now, let me explain to you guys why the builders are destroying us so much, because generally this is what happens, okay? So when you get a comp, okay, so we're going to go back into talking about comps. So when you get a comp and say a property sold for, let's say $200,000, okay? When you have an existing, or let's say used house, we're going to say used, okay? If you sell a property for, oh my gosh, look at how horrible used is. If you sell a property for $200,000, but you also give this person $10,000, say in closing costs, so as the seller, I'm giving the buyer $10,000 in closing costs, okay? Then what happens is in the appraisal, the appraiser subtracts $10,000 from the subject properties or comps value. So the value in this scenario would be $190,000, because remember, I'm removing the closing cost that is being paid. But remember what I said, this is for used or existing homes, okay? Let me show you what new home builders are doing. So this is what new home builders are doing, okay? So new homes, okay? And this is the problem. This is why I'm saying everything's so artificially being propped up. So say a new home builder sells a house, I'm sorry guys, for $200,000 again, just like the used house, okay? Now, here's what the new home builder is going to say. They're going to say, if you use my lender, they're going to pay $10,000 in your closing costs, and they're going to give you a fixed rate of 4.75%. Now, let's say that it costs, say, $20,000 to offer the fixed rate. Okay, so they're paying you guys $20,000, okay, on a rate buy down. Okay, say they're also offering you guys, say, $15,000 to the design studio. So say $15,000 design, say design incentive. Okay, right? So basically, if this was a used home, what would the value be? It would be $165,000. But because of the way the regulations are with new home builders, basically they're saying that we're not giving you that $20,000 in rate buy down. The mortgage company is, which they own. So they own the mortgage company. The mortgage company is giving you roughly $20,000 in buying incentives, but it's not being reported on the appraisal. So the value is still $200,000 for new homes. Okay? If this was a used home, remember, the value would be $165,000. You guys, we have a huge problem when it comes to new home construction. We have a lack of transparency, we have a lack of regulation, and there's really no good source of data tracking for new home sales. And because these guys have such huge margin on, I don't care that lumber's down or up, they have such huge margin on their houses, they can continue to play this game for a substantial period of time. There is a catastrophe going on in different areas of the market right now. Existing home sales, the prices, depending on the metro area, have been relatively stable. But when we look at what's selling right now, New homes. Everyone's talking about new homes. Why are they talking about new homes? Because new homes is the only thing that people can afford, because 4.5% rates, 5% interest rates, $10,000 paid back towards closing, 5% buyer's commission. There's a lot going on right now, you guys, in new home sales, and I hope that's what you got from that. Hopefully that was eye-opening. Do me a favor, you guys, comment below. Let me know if that was eye-opening. Maybe it wasn't eye-opening. I'm trying really hard. We're going to go into the Q&As right now. This is running a little bit long. Sorry about that, guys. Sorry about that little pen situation. Just going to take a couple things real quick. Charles, thank you again, brother. You don't have to send me money, man. I definitely appreciate that. Gas is like $9 on the coast of California. I'm not looking at going back because part of the I-10 is closed until further notice due to a large fire. Where's the fire at? The I-10. I hate driving the 10 through Texas, man. The I-10 through Texas is a horrible drive. But I've been through California to Texas on the I-10. It's fun, except when you get to Texas. Thank you for the support, man. Be safe out there. Stay away from the fires and let us know where it's at. All right, I wanted to throw this up real quick from Top Villain. So Top Villain is like, unemployment hit 10% in the 80s, recession and no price correction. I like to talk about the 80s a lot because it really allows us, y'all, to look at the difference in consumers. The difference in consumers is huge, okay? So we'll talk about it. That's fine. Now, first of all, the property run-up began in 1970, okay? So that was the first recession. What is that, the beginning of 1970. So going into that recession, unemployment was 3.5, okay? So the start, it was like, what, 4 recessions in a decade? So the first recession, unemployment was at 3.5. Second recession, it was about 4.8, super low, okay? And the third, can you believe it? A third recession, 6.3, and June, 7.5. That was heading into the recessions. It peaked at 9, and then the last recession, it peaked at 10, and then went all the way down to 7%. So the reason I like to bring this up is if you're going to compare the 70s and 80s to what's going on right now, you have to do a full comparison. Okay, you have to talk about savings rate, job growth rate, household size. Are both husband and wife working? Can they save? What's the PE ratio? What's the payment? I mean, you got to look at all of those things. And one of the things that I want to look at, since we don't have a lot of time, is the savings rate. Let's also look at the savings rate. Because if you get laid off and you have money saved, you're in a little bit better of a situation. Is that right? Right? You guys see what I'm saying? So if you get laid off and you don't have money, it's probably going to be a lot worse, right? Because you don't have any money. So take a look at this, guys. Look at the savings rate. And again, this is where I'll stay. I could easily put up the PE ratio, but that's all right. So right now we have a savings rate of 3.4. So we're going to talk about that recession. Let's go back to the beginning. Okay, so the first recession, going into the recession, the savings rate was 11.8% of your income. People were saving like crazy, which means they could afford. They could afford higher prices. They could afford higher prices. And look at you guys, in the recession, it got up to over 13%. And then the next recession, consumers were going into the recession at a 14.8% savings rate. Y'all hear me? 14.8. Oh my. So the first 80s recession right here, 9.7. In fact, the savings rate went up during the recession to 11.5% of income. Then let's talk about the last recession in the 80s. The savings rate peaked at 12.8. 12.8. What does it tell us? Come on. What does that tell us? Please, seriously, what does that tell us? It should tell us that people can't bear a downturn. And look at that. We saw that in the great financial collapse. The same thing. People didn't have any savings. So they couldn't handle uncertainty. So again, it just depends. That's the savings rate. It's not the total amount accumulated. But I thought that would be a great place for us to end. Let me throw up some... Vegas, what's going on, Vegas? Good stuff. You can grab $100.48 gallons of gas on me. Thank you, Vegas. You don't have to do that, brother. I appreciate you. Let me throw this up real quick from Mr. Watson. So Mr. Watson is basically, aside from the correlation, how does an inversion of the yield curve lead to a recession? So I'm not an economist, but I'm going to try to explain this simply. The inversions is not what leads us into recession. The inversion is just an indicator of an incoming recession. We're not going into recession because of the inversion, but the inversion represents a lack of profitability and profit, especially in the banking sector. If they're inverted, that means that banks and the economy is not going to make as much money. So when you do the quantitative tightening, you're selling mortgage-backed securities, you're increasing the federal funds rate, those are things that will eventually lead to recession. The inversion is just a warning. So I want to make that clear. The recession will come from the actual interest rates being high and the inability for companies to profit. And when they have an inability to profit, they usually have to lay off, right? Because labor expenses going up, profits going down. You can't go higher on prices because consumers can't afford higher prices. The next thing you got to do is layoffs. And that's, I hope I answered that okay. So one more thing, I don't know why I'm bringing this up, but yeah, I saw that. I saw it right away, like 8 minutes after that. Meet Kevin deleted all his videos. You guys watch that video. I don't know what to think. I'm going to tell you guys this right now, okay? I need to hear the bullish narrative. And I listened to Meet Kevin because I need to understand, like, at least he has data. He has data. The realtors are just emotional. At least this guy has data. So apparently he's going to start a refresh. And honestly, I hope I'm suspect. I'm suspect because that's the man deleted 2,500 videos. That's crazy. That's so much work. So I'm a little suspect. Maybe there's some regulatory things, maybe a copyright strike, but either way, what I'm going to lean on is, man, I really hope that guy does well. I mean, you know, we all deserve to have a second chance. Okay. If that's what he really wants. So look at that video. Look at that video. Very, very interesting stuff there. All right, guys, I think that's going to do it for today. Boom, 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 boom. I hate emotions. He did delete his video. So Kevin is he's a YouTuber. I enjoy listening to him. Very intelligent. He's going to take a lot more bullish approach. He's a lot more well off than us. Like he's got money and liquidity. He's got all this stuff. So his mindset's different than our mindsets, where I'm like poor, right? Like I'm just a normal poor person. So I find that bullish narrative important because it allows me to think what I believe and use his information. But I really hope that guy's okay, and I hope he does well. And that's where I'll end it. So anyways, guys, in conclusion, you know, I want you guys to comment below. Are we in round 2 of the housing market recession? I think we are. I think what we need to be doing right now is hang on, stay steady, watch the data. And other than that, guys, if you're, oh yeah, FTX, SCS. Okay. Here's the thing. I see you guys' comments here. I'm not a guy that's going to kick someone when they're down. I can't stand it. I don't care if I don't like you. I don't care if you've been trolling me or whatever it is. I can't see it. So I'm not going to throw up those comments. You don't kick people when they're down, guys. You don't kick people. Well, Americans, right? They're on our team, right? I'm not talking about Tara, but you don't kick someone when they're down. Okay. I can't do that. So anyways, I love you guys. And if you're